Hello, welcome to your October 4Thought. I'm Nathan, he's Loren, you're you, and we appreciate you clicking the link and joining us today. I think we have, in previous videos, we've spoken about a lot of topics, and as you would say, evergreen topics. So a lot about, maybe what we're doing with portfolios in general, or financial strategies, financial planning strategies, investor psychology, things of that nature. Last month we talked about insurance, which was, I'm sure, everyone's favorite video that we've ever done.
It can only go up.
I know.
From there.
I know. What in all honesty, we do want to be comprehensive, and everyone and all of our colleagues at Confluence are trying to strive to be, very comprehensive in the services we're providing. And if we didn't talk about protection services, about insurance, we would not be holding up our end of the bargain. So that's something we definitely want to do, and I'm glad we did that. And I actually had a client reach out. I had one client reach out to me and say,
what do they always say? If this just helps one person, then it was worth it.
If that's right. So I agree. So I guess that I'm happy they reached out, and I'm happy to help them. So today we were going to talk maybe a little bit about current events.
Yeah.
Something that's happening right now, as opposed to those subjects, and as a little departure from what we usually do. I think that's good to change.
Here's the question of the day: Is it data or data?
I know, right? I say data. I think.
No, you're wrong. So we're going to get more into some. I don't know if we're going to go into like data-driven statistics.
Sure. Not too much,
but maybe a little bit more topical, a little bit about what's going on.
Broad
now.
Strokes about what you might be hearing, seeing, or reading.
Yeah, and maybe some impacts. Maybe
and how that impacts you and your portfolio, et cetera. Maybe you're wondering what our thoughts are. We want to share those things with you and our firm's thoughts on things. But first, before we do that, you spoke the last video about a trip, your end of summer trip, which was officially the end of summer because you extended it. You wasn't in June, July, or August.
No,
it was in September.
Yeah.
So how'd it go?
I mean, again, your thoughts and everything on your vacation, much deeper than mine. I think what I was most concerned about, because I have a 4 and a 5-year-old, and I haven't really flown with them.
Mm-hmm.
So I took a trip to Myrtle Beach, which was like 15 minutes.
First off, how was the flying experience?
Just as bad as I remember it, maybe even a tiny bit worse.
It's gotten worse.
But I will say, and I'm not trying to tie this into financial planning, but putting the planning in, thinking about what they needed on the flights, the time frame, where we were going to go, prepping them for the trip, they couldn't have been better.
Okay.
They were fantastic on the flights.
But you're setting me up for something.
What I realized is I didn't prep them for Janelle's birthday dinner. We went out to a high-end,
your wife,
fancy
Janelle,
restaurant,
right?
A white tablecloth.
Fancy.
Yeah. So I don't do that enough, because once we got there, I think that freaked the kids out, and they hid under the table.
Oh.
I think maybe they thought that's where they should eat, under the white.
They were like, it's a fort, and they're under the fort. I mean, let them do whatever.
So lesson learned. Always important to do planning. Maybe more important what you're planning for.
No, and you told me your wife rented a vehicle that now she wants to own.
Yeah, I think everybody, when they go to the beach, either wants to get a Mustang convertible, at least if you're from my generation, throw that top down, or a Jeep Wrangler. So we rented a Jeep Wrangler. Everybody loved it. But luckily, I've got a person in my life that reminded me that, hey, you don't live in the South.
Well,
Jeep Wrangler's a lot of fun. When
I love Jeeps. As a former Jeep owner and as a former Floridian, I'll say Jeeps are great, but they're better in the South.
Yeah,
they're better in the warm weather. Warm weather where you'd have the top down almost all the time is a better place.
And I see, as soon as I come back from my trip, now it's in the 70s. The whole time I was away.
Well, exactly. You officially ended summer, and when you came back, and now the leaves are falling out. My wife says it's happening a little too soon. The leaves are coming down as in our driving home. She's looking at these trees, and they were green, I feel like, a week ago. And now they're not only changing colors, but just dropping. And so it's maybe happening a little too fast for her, maybe a little too fast for me.
Let me make it worse for everybody. We're less than 100 days away from Christmas.
Yeah, I'm not ready for that. It's coming. It always comes up really quick.
So lots of things are changing.
Yeah, no, for sure. And so speaking of things that are changing, things that are falling, see what I'm doing there? I'm talking about interest rates. So we were going to talk about some things that are happening right now, or things that have happened, transpired since our last video. And I think we should probably have the focus point should probably be interest rates and the Fed, and we'll go into some other things too. But why don't you go through a list of things just in the last 4.5 weeks that have occurred that are just high.
Yeah, this is very, very high level, and then I'll let you dig into some of the juicy stuff, and then I'll talk about maybe some of the more boring stuff. So, and I'm going to read this to make sure I get it right. So as of the last time we filmed our video, heard a lot about it, Fed independence under pressure. So there's definitely been some pressure in this administration, maybe it's happened from past administrations, but maybe it feels a lot more transparent, a lot more animosity. So Fed independence under pressure. Even though we've had a strong GDP number, that's added a little bit to the inflation. So maybe inflation is starting to tick back up. It's still a little sticky. Weak labor market, so the jobs data has gotten a little bit soft. With all of that, maybe this what's led right into it. You've had the FOMC, or the Fed, has had a rate cut.
Yep.
And then we'll talk a little bit about some of the implications of that, whether that's liability side, investment side.
Sure.
So I'll let you go first as usual.
Yeah. So I think a lot of people have heard and read about the Federal Reserve lately, and they're cutting interest rates. We've also read a lot about, as you pointed out, there's been some influence, or I guess the current administration trying to influence the Fed to maybe change rates to better fit with their policy. Now, I think if you look historically, we've probably seen this occur many, many times across many administrations. I think what's different maybe is the explicit nature that's happening right now. It might be a departure, but the Fed is still independent, and we are glad it's independent. I think most people would agree it's better to have an independent Fed, one that makes decisions as objectively as possible.
Right, trying to use information that they're gathering. And that's been tough for businesses sending in the information. So there's been some revisions that they've had to be made.
The data collection is probably not the best method. Maybe sometimes they need.
But maybe that's a point of improvement that it can only get better as well.
Right. Yeah, definitely. So the Fed, and speaking of the Fed, this guy used to work for the Federal Bank of Cleveland, so he may know a thing or two.
The late 1900s, I worked for the Federal Reserve Bank of Cleveland.
Do you text Fed Chairman Jerome Powell?
Yeah,
Do you text him all the time?
Jay
Powell, as you like to say.
I call him Jerry. What's funny is I call him Jerry in all the emails I've sent him, but he's never replied.
Never comes back.
So I'm doing my best for everybody out there to put our input
what's going on
into
with
the
rates.
mix. But as of yet, maybe after this video, things will change.
So the Federal Reserve, and maybe you should be talking more about this, but the Federal Reserve, obviously the chairperson's been there for now 3 administrations. So Trump 1.0, Biden administration, now this current administration. So he's been there a while. His term ends next year. And he's, quote unquote, in charge, probably has the most influence by a large measure, but there are other members of that. And there's been some dissent. You've probably also read a little bit about that. So meaning there's some members of that committee
that's
that
what
don't
we
agree.
call it. The FOMC is the Federal Open Markets Committee.
Right.
So there's a group of people on there. They all vote.
Yep.
And theoretically, that vote is what either has a rate change, doesn't have a rate change, and that rate change would be up or down.
Yeah, and so we've had a rate cut for the first time in a while. I think we've been talking and thinking maybe rates are going to happen sooner, and we've had an expectation of maybe 6 rate cuts at the beginning of the year.
Right, the beginning of the year, I think it was 6.
Now it's maybe shifted to 2 or 3, and we've just had 1. So it's been a lot of change in that regard. But they did make a 0.25 or 25 basis point reduction. There was talk of and dissent in the committee whether they should do it, A, and then B, whether they should do more, so 0.5 or 0.5%. But generally speaking, if you make moves in a bigger way and a 0.5% cuts, it might signal that there's something maybe worse in the economy
on the horizon
than
for
there
the
is.
economy.
Yeah.
So I think a conversation could be had either way. Did he wait too long? Did he not cut enough?
Yeah.
Well, that's an academic discussion because now it's happened.
Yeah.
So what are some implications of that?
So I think also, just getting into that rate cut in, so we've had, there's a dual mandate, right? I think I want to talk about that. So the Fed has this dual mandate, and I think one of the reasons they've been given pause with reducing rates up to now is part of that mandate is keeping prices steady, the inflation part, right? And that's been a news story for 5 years. And so, but inflation isn't at 10% or 8% or 5%.
Yeah, I think people forget that it was over 9%. It was too long ago.
Yeah, and that's just the cost of goods and services rising over time, two different components, as you would point out. But so it is calm, right? So it's not 5% or 6%, but it's also not 2%. And I think 2% has been their target that they've stated that's what they want to get to. Yeah. And there's some sticking components to inflation that's keeping it from getting there. So, but they have been focused on that. And so maybe we're trending at 2.5, maybe it's 3, depending on what measure you're looking at or which data point or data point you're looking at. But so they're not at 2%, but I think that stickiness, I think they've come to the conclusion maybe at this point that with the new jobs information that we've received over the last few weeks, they're seeing, maybe there's some weakness here, and we don't want that to increase, and we don't want unemployment to increase. Unemployment's been very low for quite some time, historically so. But now if they start to see some increases, it's maybe shifting their focus to what's maybe, okay, this is going to be the hill we're going to die on is going to be the labor market. We're going to focus on that. We're going to make sure that stays firm and stays strong. So that's another reason that's led them to make this decision. And we think probably not we, I shouldn't say we, the information that we see from the market indicates there's a likelihood of another rate cut, possibly 2 this year.
I think you covered this, but I just want to put some emphasis on it. The Fed's loosening credit.
Right.
So that just means they're trying to stimulate the economy by making borrowing cheaper.
Right.
Is that fair?
Yep.
Should I talk a tiny bit about small caps now, or do you want to wait till we do that?
No, do that. I think I think that's something I'm going to let you talk about it.
So there's lots of different equity components. So just like we were talking about the strong GDP numbers, as of this recording, the market's hit new highs. I feel like every recording, at least recently, and I hope it continues, that the market's hit new highs. So if inflation's sticky and the jobs are soft, what are some reasons that the stock market keeps going up? And there's lots of different ones. We're not going to talk about them all today. We're just kind of going to focus on interest rates. Mm-hmm. So small caps or smaller companies, and a lot of times those can be local companies that are regional. Really, it just means the stock price times how many shares are outstanding. And basically, small companies have a harder time getting loans.
Mm-hmm. Harder to finance, right.
Harder to finance. Yep. So the loans they do get are much higher.
Yep.
So when the Fed cuts interest rates, that makes their borrowing cheaper, which increases their profits.
Yeah, so you've seen a bump there in stock prices.
You've seen a big bump in stock prices. I think that's one area of the market. So just like we said, loosening this interest rate isn't just good for consumers being able to borrow. Mm-hmm. It's also good for companies that make up the stock market for them to borrow cheaper.
So I think it would be fair to say the market views a rate cut as a positive thing. It was highly anticipated.
That's true.
And there were some moves in the market before the rate cut actually occurred. And I think it's seeing that play out in a positive way. And I think it probably wants further rate cuts later this year. I think that's probably fair to say as well.
So I talked a little bit about the equity. Do you want to talk about the fixed income component of people's portfolios?
Sure.
And how that's
well, I can talk. I'll say I'll start and you finish. But the fixed income component of many clients' portfolios, depending on who you are, you might not have hardly any. If a lot of clients of ours are just growth focused, they shouldn't have much fixed income in their portfolio. But then we have many clients who want to blend in more diversifiers, want to blend in maybe for income purposes, need that income in the portfolio. So they have that. And for the last 2.5, 3 years, this fixed income is under, I don't want to say performed because that's what you do on a stage, but the results historically have been below average, right? Yeah. So those results have been below average because interest rates have affected those in a negative way. Now, maybe there's some relief in terms of the interest rate dropping and then the bond prices firming up in your portfolios. Now, the yield has been pretty nice. So if you've been collecting that yield, that's been good. And it's also nice that even if Fed rate drops a 1/4 point, that doesn't necessarily affect every range or every maturity that you have in your portfolio.
Yeah,
it's different.
That's very good. I like that.
And maybe if you could finish that thought or either lead us into maybe mortgages too, and how the short end of the curve is what the Fed is doing. They're pulling that lever, but that doesn't necessarily affect mortgage rates, which are based on longer term rates.
So not only am I an expert from working at the Fed, I also just bought a house recently. So I'm in the meat of how bad interest rates were at one point in time. So I think you did a great job, but I just want to give some technicalities to it. So traditionally, when interest rates go down, so we just had a rate cut, traditionally bond prices go up. Mm-hmm. So like Nathan said, bonds were doing their job on one aspect, which they were generating an income.
Sure.
Where they weren't doing maybe their best job was acting as a buffer when the market would dip. So you didn't see a lot of capital appreciation from bonds.
Yeah.
So in the last 6 months or so, because the market lives in the future, Nathan was identifying that the market was anticipating rate cuts. And because of that, they were buying more long-term bonds, which was causing those prices to go up. So if you look at your statement or reports when we're kind of doing reviews with you, if you see longer term what the bonds were performing versus today, you've seen a dramatic difference for the better.
Yeah, absolutely.
So covered that. on mortgages, what makes it really, really difficult is the Fed only controls short-term rates. So the overnight rate. So the Fed loans money to banks. And of course, banks loan money to you and companies and everything else. So that spread is where the bank makes its money.
Yeah.
So when the Fed decreases interest rates, the bank is going to decrease the amount that it's lending. I'm going to give you a loan at 6%. Now I'm going to give you a loan at 5.75%. But to make up that difference, they're going to have to lower the interest that they're paying you on your short-term deposits. So if you have a checking account that still bears interest, I don't know if that exists anymore. Savings account, same thing, money market, shorter-term CDs. Yeah. That's the problem, is that savers really get hurt when the Fed lowers interest rates. So it's good for consumers because they can borrow cheaper. Yeah. It's good for companies because they can borrow cheaper. Bad for savers.
And they could diversify out of those things, right? So instead of those instruments that are short-term, like CDs and money markets, diversify out into longer-term fixed income, things of that nature, which we've been talking about for a while, and leading us into this point that we're at today. And then also, as far as mortgages, I know you just bought your house, and so a lot of people have been waiting for this because they're thinking, okay, now the Fed's going to reduce rates. Now I can buy. Now I can get in the market, or now I can refinance the home that I just purchased. I feel like is at a higher interest rate. But historically speaking, too, over the last 50 years, if you have mortgages that were at one point 10 and 12%, and you got one at 7, it's
doesn't feel great.
Not the end of the world. But you just a few short years ago, you could get it at 3. It does that. That's the kind of that relative aspect of like, this is a big delta change from what we could have had just a few years earlier. So what's happening with mortgage rates?
Yeah, I mean, not much. So we did have an interest rate decrease not too long ago. And for some reason, we're seeing a similar, history doesn't necessarily repeat itself, but sometimes it sure looks similar. Yeah. So just like Nathan said, mortgage rates are based off of longer duration bonds. The Fed doesn't control long duration bonds. So the kind of marketplace determines what interest rates are on longer term bonds. And just like we talked about, people are kind of locking in those longer term interest rates. They're not selling those. And you haven't seen a big refinance boom. So interest rates dipped a little bit. We just had a 1-year low for mortgage rates, but they're starting to creep back up.
Yeah, so there's still hope, right?
There's still hope. And what I would say, just to interrupt, like I always do, is that's a component we can help. So if you're not sure, hey, maybe you had a 7%, maybe now it's 6.36 and you're tempted, talk to us. We can help you figure out, does it make economic sense to do a refinance?
Sure, that's a good point.
Obviously, you'd want to talk to your banker as well, but if you want an outside perspective, we can give you that too.
Yeah, so there's still hope, even though it hasn't transpired yet. We just want to point out, obviously, the short end that the Fed is manipulating isn't necessarily going to move in lockstep with any longer term yields, such as that are influenced and connected to mortgage rates. But maybe if the Fed continues down this path, you will eventually see later this year or in the spring. So there's, it might happen. You might be able to refinance that mortgage, right? Yeah. So there's still hope that will decrease. Remains to be seen. Yeah. And we mentioned all these things that are happening right now, or that has happened just in the last few weeks, because there's been a lot of activity. We want to make sure that we're sharing thoughts about those things with you. But also, if you hear something in this discussion, or you read something elsewhere that you want to learn more about, or that you're confused about, feel free to contact us. We want to engage with you in that way. We get a lot of those, through just regular conversations and client reviews already, but we're happy to talk with you about anything that comes up in terms of anything you're hearing, seeing, or reading elsewhere.
Yeah. And, we're doing this through the videos. We're trying to meet with as many people as we can, it's almost year end, like I said, which is crazy, but we're also, the firm itself is trying to do more outreach. So you'll see, if you haven't already seen it in your email, I'm sure you'll get a reminder coming up. We're doing 2 in-person seminars, which I don't think the company's done for a long time. So we're trying to get as many people as possible. I've had some feedback from clients saying, hey, this must not be for me because I'm a current client. We would encourage everybody to come, because one, you get to actually interact directly with firm leadership. And where Nathan and I worked before, and like I joked about before, and when I worked at the Fed, if one of my friends had a conversation with me about interest rates, I couldn't connect them with the Fed governor. But here, if one of my friends or clients or prospects says, hey, what's the firm's thinking about X, Y, or Z? I have the ability to put them in direct physical contact where they can ask that question.
Yeah, it's great. It's a nice opportunity to get together, and we look forward to seeing you there if you're interested. So I think we'll include a invite link in this message.
Yeah. So as always, we really appreciate the time. We're trying to make these as impactful as possible. That's why we wanted to do one that was a little bit more data-driven.
And also entertaining. That's why I brought up your trip, because anytime you talk about your kids and your family, it's fun. I like it. I like it. I think they do too.
Yeah, so I guess we'll learn more about that from the feedback we get. But so thanks again. We really appreciate it. We know your time is valuable and you can never get it back. So thanks for giving us some.
Thank you. Talk to you soon.